Sharp profit growth can be a sign of health, or a sign to look deeper. For Union Bank of the Philippines, the first quarter of 2026 was, on the surface, a powerful display of recovery. Net income soared 167%, reaching 3.83 billion pesos, and net revenues climbed to 21.73 billion pesos. Beneath the numbers, the bank's core operating leverage finally turned in its favor after years of expansion and investment. What powered this turnaround? The net interest margin, now at 6.7%, up from 6.3%. Funding became cheaper as interest expense dropped nearly 18%, even as earning assets continued to grow. This kind of asymmetry, assets earning steadily while liabilities become less costly, is the sort of progress bankers strive for. The improvement continued beyond revenue. Operating expenses rose, but less sharply than revenues. Provisions for credit losses fell by 18%. Pre-tax profit nearly doubled, while efficiency improved, reflected in a lower cost-to-income ratio. Even returns, on equity and on assets, rose meaningfully, signaling sharper profitability. Other income, especially from foreign exchange gains, provided further support. Yet, a loss on trading and investment securities offset some of these gains, showing that not every boost was repeatable. The balance sheet tells a subtler story. Total resources grew to 1.18 trillion pesos, and deposits to 751.7 billion pesos. But the deposit mix shifted. Demand deposits fell, savings remained flat, while time deposits jumped 12%. As COSA, the cheaper fuel for banks, declined, time deposits' higher cost could threaten future margin gains. The current positive NIM trend may need reinforcement from stronger asset yields or rate cuts if this pattern persists. There's another layer to consider: comprehensive income. UBP recorded an unrealized loss of 1.18 billion pesos on its investment portfolio, primarily due to bond values falling amid rising yields. While not a cash loss, it pulls down total comprehensive income and puts pressure on capital ratios, which declined but remain within safe limits. For investors and analysts, the quarter offers assurance and a warning. Core earnings are stronger, margins are wider, credit quality is improving. But shifts in deposit composition and bond market volatility pose risks that can erode these gains. UBP has shown it can capitalize on efficiencies and rate movements. Yet, future performance will depend on its ability to maintain low funding costs, manage market-driven losses, and adapt its loan and investment strategies. The bank's story in Q1 2026 is not simply of resurgence. It's a reminder that banking rewards come with caveats. The spread machine is running smoothly, for now. The real challenge is sustaining this performance as pressures from depositors, bond investors, and shareholders all intensify.